Hi, I'm Nate Cosman, President of the Ross Lowe Financial Group. We are committed to keeping you informed about the trends we see in the marketplace. The Ross Lowe Financial Group will be launching a series of periodic videos to educate and keep you informed. If you're an active client of our firm and wish not to receive links to our videos, market commentary, newsletters in the future, please email info@rosslowfinancial.com with the word unsubscribe in the subject line. If you're not on our mailing list and wish to be, either email subscribe to info@rosslowfinancial.com, like us on Facebook, follow us on Twitter, or connect with us on LinkedIn. Today we're going to talk about bonds. In particular, we're going to answer a few questions. Why do investors own bonds? What's the outlook for bonds? And what are some attractive alternatives in the current and upcoming environment, as well as some action steps to consider.
According to our research, stocks have returned far more than bonds over the long run. So why own bonds at all? Bonds and stocks have low correlation, meaning they seldom move in the same direction at the same time. Uncorrelated assets mean that you can reduce risk. At times, stock prices may be falling, but bonds may remain unaffected. Because bonds provide current income in the form of dividends, they tend to be less volatile than stocks because of that stream of income. The income can provide a floor to support the investment portfolio. Because the markets are unpredictable, most experts recommend having a portion of your portfolio in bonds and other low correlated asset classes to help reduce risk. This is called asset allocation. Keep in mind there are different kinds of bonds. They are differentiated by issuer credit risk and duration. Investment grade bonds issued by the most creditworthy of issuers yield less because they are safer investments. Junk bonds or speculative grade bonds may produce a higher yield, but they also carry a higher than average risk that the company will default on the bond. Duration speaks to the maturity of the bond or the bond portfolio. The longer the duration, the more susceptible the bond is to interest rate risk. When rates go up, these bond prices will fall more than the prices of short-term bonds.
To understand where bonds are today, think back to where mortgage rates were 30 years ago and where they are today. Even if you didn't have a mortgage 30 years ago, maybe you heard your parents or grandparents talk about paying double-digit interest rates on their mortgage. Today, we're at all-time lows. Remember from economics class that bond prices and interest rates work like a seesaw. When one goes up, the other goes down. As rates have dropped over the last 30 years, bond prices have soared, narrowing the gap between stocks and bonds. Stock market volatility over the last decade and an aging population that tends to favor fixed income investments have also contributed. A risky market and a need for income has prompted investors to move to bonds. According to JP Morgan, investors bought close to $680 billion in bonds in 2012. A simple understanding of supply and demand would indicate that this has also contributed to increased prices in bonds. Here, going forward, is that money is beginning to return to the stock market and interest rates can fall no further. A reversal in both of these may seem likely, and the combination could be adverse for certain types of bonds. No further.
Typical reaction to rising interest rates might be to shorten duration or to increase yield. We think with the economy strengthening and a gradual rate increase hinted by the Federal Reserve, that increasing yield makes more sense than shortening duration. A recent paper by Nuveen suggests that investors have fared best in high yield in past rising rate environments. In fact, the returns were almost 5% higher in high yield bonds than in investment grade. Obviously, that comes with the disclosure that past performance is not a guarantee of future results. Another area we're reallocating to is non-traded real estate investment trusts and non-traded business development companies. These investment vehicles are potentially illiquid, speculative, investments and are not suitable for everyone, but are worth a consideration for some investors seeking income and to diversify their portfolios. Lastly, some investors with longer time horizons might consider reallocating to a heavier equity position.
We think the environment is right to look at your portfolio and reconsider your liquidity needs, time horizon, and risk tolerance. We have a proactive review process in place where we will be looking over our clients' portfolios each calendar quarter. If you don't have someone to guide you, please don't hesitate to call.